Okay, so we have a topic related to deposit insurance. So, in this topic, we go about the failure of Punjab and Maharashtra Cooperative Bank, and that is exposed limitation to India's deposit insurance systems. So, now here, that issue is that the insurance amount to a mere rupees 1 lakh per deposit. So that is the issue that several bank failures over the years have severely strained RBI and central government resources. Now the bank failures erode depositor confidence and threaten financial stability, presenting an urgent need for deposit insurance reforms in the country. And also, the bank with full deposit insurance has minimal incentives to be prudent while making loans. So depositors deposit in a bank which offers high interest rates without caring for the bank risk profile. What are the need for reforms basically? Need is a sound deposit system is basically needed, and also it requires maintaining depositors' confidence while minimizing deposit insurance direct and indirect cost. Now boosting depositors' confidence and reducing direct and indirect costs require careful structure of both the quantity and pricing of the deposit insurance. Now, what all are the recent reforms? The insurance limit has been increased, that is from 5 lakh in 2020. Now, into the 2021 Union Budget, amend the DICGC Act, allowing immediate withdrawal of insured deposit without waiting for complete resolution. So, what is the critical if we analyze it? It acts post bailouts are costly. The bailout process tends to be longer, complicated, and uncertain, further eroding depositors' confidence in a banking systems. All the banks pay the same insurance premium respectively for their risk profile. Now, risk-based approach will ensure that Insurance Deposit Fund of DICGC has sufficient funds to make quick and timely repayment of depositors and will control the bank giving risky loans. So we have another article that is related to economy, and that is non-bank payment system. So it is also related to economy, and it is like sending money online or withdrawing cash using a mobile wallet or non-banking entity through real-time gross settlement, means RTGS, and that is through a non-bank. And also National Electronic Fund Transfer, that is the centralized paying system, CPS of the Reserve Bank of India, will soon become possible. So what are the RBI done to facilitate this? The RBI proposed to enable payment systems operators like mobile wallets regulated by central government to take direct membership in RTGS and NEFT. Now, this is expected to minimize settlement risk in financial system and enhance the reach of digital financial systems to all user segment. So this entity will not be eligible for any liquidity facility from RBI to facilitate settlement for their transactions in the CPS. What all are the implications? Opening the payment system to non-bank would increase digital payment and transaction significantly. So it will prepare a digital trial of all individuals doing digital transactions on channels outside the banking system. Now one's credit profile can be tracked while taking a loan from a financial technology, that is a fintech companies, and investing through it to spending through it. Now with the RBI not now allowing non-banks to withdraw cash subject to a limit that is of 20 lakh that has been imposed, dependence on bank is likely to come down. So who can undertake this online transfer? So the RBI will now allow non-bank entities like prepaid payment instruments, EU issuers, card networks, white labels, ATM operator, trade receivable, discounting systems, trade platforms to be become members of CPS. Now, mobile wallets can provide NEFT and RTGS facility to their customers. Why it is hike in cash limit important? That RBI has decided to increase the limit of the outstanding balance in PPIs of non-banks from a current level of 1 lakh to 2 lakh rupees. Now this will facilitate the incentivized online transfer and cash withdrawal from non-banks and enable them to go for full KYC compliance and interoperability. Now how is digital payment taking shape? In 2019 to 20 onwards, the large value credit transfers through RTGS dominated digital payments, accounting for over 80% of total value of digital transactions. Now, in terms of volume, credit transfers via multiple channels such as UPI, NEFT, and immediate payment services are leading. In case of card payments, the value of that credit card transaction registered a growth of 35.6% as against 21.1% for credit cards in March 2020. Social distancing requirements during the pandemic led to the digital mode of transaction being preferred over cash. So we have another article that is related to economy. That is bankruptcy code. We know that bankruptcy code is in news, so it is also related to GS paper 3. Now, insolvency and bankruptcy code is transitioning from creditor-friendly approach to a promoter-friendly approach. Now, from a creditor-friendly approach to a promoter-friendly approach, it is transitioning. Now, what are the pre-packs here? That the government has recently introduced pre-pack for micro, small and medium enterprises. Now, the framework involves a privately negotiated contract between the promoters of a financial distressed firm and its financial creditors to restructure the company's obligations before the commencement of insolvency proceedings. Once accepted by creditors, the plan must be presented to the National Company Law Tribunal for further approvals. Now, the firm's promoters could also submit a resolution plan subject to restrictions imposed under Section 29A of IBC Act. We know that Section 29A talks about. According to the Act, in the eligibility criteria for submitting the resolution plan applies to pre-pack as well. Now, what all are the recent changes? Earlier, after the initiation of insolvency proceedings, control of a firm is taken from its pre-existing promoter and a resolution professional is appointed to manage all the affairs of the company during this process, during the resolution process basically. Now, during the restructuring, the promoters through pre-pack retains the control over the firm. So that has been pre-packs has been introduced, and now the promoters could have the control. Now, absence of an open bidding process during the resolution phase may raise question over price discovery if value maximization of creditor is used to check the efficiency of IBC. And if we critically analyze that, then we'll find that the control of the promoter over the insolvency proceeding is a realization of their inability to honor obligations as due to COVID. Now, this is a good step and removes the existing prejudice against promoters that all business failures is due to the connivance of promoters. Now, this is a win-win case for both the promoters and the borrower as it retains the control of the firm with the promoter and may increase the cash flow that is good for the creditors rather than liquidating a loss-making company. Now, again, we are reading this pre-pack scenario. Now, the government has introduced pre-pack for micro, small and medium enterprises, not for the larger enterprises it is. Now, the framework involves a privately negotiated contract between the promoters and the financial distressed firm and its financial creditors to restructure the company's obligation before the commencement of insolvency proceedings. So, it is before the proceedings, we need to remember. Once accepted by the creditors, the plan must be presented to the NCLT for further approval. Now, firm promoters could also submit a resolution plan subject to restriction imposed under Section 29A of IBC. Means even it has a restriction, and their firm's promoters is also has to, if they have something, they could also submit their resolution plan here. So according to the Act, the ineligibility criteria for submitting the resolution plan applies to pre-PACs as well. That is done.